Hello and welcome to BearishBulls channel. In this video we'll talk about how Marathon Oil will profit from commodity prices above break-even prices. How Marathon Oil started a hard restructuring program 2 years ago designed to lower costs. How oil and gas stocks including Marathon Oil could be winners in a continued recovery. With commodity and oil prices stabilizing, fossil fuel companies may be primed for a triumphant return to the stock market in 2021. Marathon Oil or the MRO may have 50% or more recovery potential, under the condition that energy prices remain above break-even prices. First off is the oil market. Oil prices declined steeply in 2020 as the pandemic unfolded, which led to a historic drop in West Texas Intermediate crude to negative $37 per barrel. WTI crude had its best month ever with a 90% gain in May of last year, and oil prices have been on a long recovery march since reaching a bottom in April 2020. WTI crude prices have now recovered to $61 per barrel, and this price recovery creates a favorable backdrop for independent E&P companies. The price drop to negative $37 was truly historic, but we have come a long way since. At this point, it is useful to make a disclaimer about the risk of an investment in independent E&P companies like Marathon Oil. They are extremely risky and the bull case depends on a few assumptions that I present in this article. Bankruptcy is a very real risk for E&P companies amid dropping commodity prices, and you must include this into your risk analysis. U.S.-centric, multi-basin portfolio Marathon Oil's U.S. production averaged 280,000 net barrels of oil equivalent per day, BOED, in Q4 2020, a performance achieved largely through its two core production locations. The Eagle Ford produced an average of 82,000 net BOED in Q4 2020, and the Bakken averaged 110,000 net BOED. Marathon Oil's less valuable northern Delaware assets produced a relatively minor 21,000 net BOED. Outside of the United States, Marathon Oil is active in Equatorial Guinea where production averaged 72,000 net BOED for Q4 2020. Countermeasures to the crisis. Countermeasures are reactive in nature and tend to have a lag effect. This means, E&P companies can only react to lower commodity prices by cutting costs after the fact, and it usually takes some time before cost programs have their desired effect. Once energy prices drop as they did in 2020, it really is all about damage control for oil and gas companies. Correspondingly, Marathon Oil reported a huge operating loss of $1.2 billion and an even larger net loss of $1.5 billion for FY 2020. Marathon Oil entered a deep restructuring in FY 2020 as demand for fossil fuels dried up and the world faced an unprecedented shutdown of business activities. This restructuring is not completed, and it could yield nice results when commodity prices stabilize, or even rise. As countermeasures to the crisis, Marathon Oil cut its dividend and put into place an ambitious cost reduction plan to adapt to the challenging commodity price environment. Based on management guidance, Marathon Oil is targeting a 30% reduction in production and general and administrative costs versus 2019. Marathon Oil already lowered its production and G&A expenses by 20% in 2020. These countermeasures are designed to reduce Marathon Oil's cash burn and should be seen in conjunction with recovering commodity prices. Dallas Fed Energy Survey, positive oil and gas outlook and break-even prices. Break-even prices determine if companies can cover their production and operating costs and make a profit. When market prices are below break-even prices, it is obviously better for companies to not drill at all because every barrel that is being taken out of the ground translates into a financial loss. Average break-even prices, depending on production efficiency and location for American E&P companies, are somewhere between $20 to $40 per barrel based on information presented in the Dallas Fed Energy Survey. Marathon Oil has said that its corporate, free cash flow, break-even point is below $35 per barrel of WTI, which is much lower than the current WTI price of $61 per barrel, and this presents a favorable investment climate. The Dallas Fed released its Q1 2021 energy survey in March that also showcased a dramatically improved outlook for the oil and gas sector based on a strong improvement in the aggregate employment index and a drastically improved 6 months outlook. This is largely attributable to the rise in commodity prices since April of last year. Is Marathon Oil Corporation stock still a buy after falling negative 5.09% on Monday? Buy or hold candidate. Since the 1st of April 2021 lost negative 5.09%, the Marathon Oil Corporation stock price fell by negative 5.09% on the last day, Monday the 5th of April 2021, from $11.79 to $11.19. During the day, the stock fluctuated 6.09% from a day low at $11 to a day high of $11.67. The price has been going up and down for this period, and there has been a 1.54% gain for the last 2 weeks. Volume fell on the last day along with the stock, which is actually a good sign as volume should follow the stock. On the last day, the trading volume fell by minus 25 million shares, and in total, 28 million shares were bought and sold for approximately $311.87 million. The stock lies in the lower part of a very wide and strong rising trend in the short term, and this may normally pose a very good buying opportunity. If the lower trend floor at $10.77 is broken, it will firstly indicate a slower rate of rising, but may also be an early warning for a trend shift. Given the current short-term trend, the stock is expected to rise 49.59% during the next 3 months and, with a 90% probability, hold a price between $16.11 and $21.83 at the end of this 3-month period. Signals and forecast: the Marathon Oil Corporation stock holds buy signals from both short and long-term moving averages, giving a positive forecast for the stock, but the stock has a general sell signal from the relation between the two signals where the long-term average is above the short-term average. On corrections down, there will be some support from the lines at $11.02 and $11.10. A breakdown below any of these levels will issue sell signals. Some negative signals were issued as well, and these may have some influence on the near short-term development. A sell signal was issued from a pivot top point on Friday, March 5, 2021, and so far it has fallen minus 13.79%. Further fall is indicated until a new bottom pivot has been found. Furthermore, there is currently a sell signal from the 3 months moving average convergence divergence, MACD. Volume fell together with the price during the last trading day, and this reduces the overall risk as volume should follow the price movements. Support, risk and stop loss: Marathon Oil Corporation finds support from accumulated volume at $11.16, and this level may hold a buying opportunity as an upwards reaction can be expected when the support is being tested. This stock may move much during a day, volatility, and with a large prediction interval from the Bollinger Band, this stock is considered to be high risk. During the last day, the stock moved 67 cents between high and low, or 6.09%. For the last week, the stock has had a daily average volatility of 5.71%. Our recommended stop loss, $10.73, negative 4.14%. This stock has high daily movements, and this gives high risk. There is a sell signal from a pivot top found 20 days ago. Is Marathon Oil Corporation stock a buy? Marathon Oil Corporation holds several positive signals, but we still don't find these to be enough for a buy candidate. At the current level, it should be considered as a hold candidate, hold or accumulate, in this position whilst awaiting further development. Due to some small weaknesses in the technical picture, we have downgraded our analysis conclusion for this stock since the last evaluation from a buy candidate to a hold, accumulate candidate. Notably, the survey also included price expectations for WTI, with survey respondents expecting the WTI price stabilize around $60 per barrel by year-end 2021, well above Marathon Oil's break-even point. The dividend is back, but it shouldn't matter to you. Whatever your conviction, understand that energy prices are uncontrollable and MRO is and will continue to be exposed to substantial risk moving forward. Folks, if you want more insights like this, please make sure to check out the other videos under Bearish Bulls and don't forget to subscribe. Thank you so much for watching, and we'll see you in the next one.